Hello, everyone. My name is Sean Cecil. I am here to host this webinar sponsored by Savvly, your personal pension designed to provide lifelong financial security and peace of mind. And I'm here with Professor Dimitris Papanikolaou, who is a professor of finance at the Kellogg School of Management at Northwestern University. Welcome, Professor Dimitris. How's it going?
Hi, Sean. It's a pleasure to be here. I'm
Yep.
really happy to do this.
Yep. And so for those watching, I've worked with Professor Papanikolaou before. So let's just dive in. So Dimitris, when it comes to retirement and the challenges facing people today as they prepare for their retirement, what is most salient? What should people be thinking about? What advice can you give?
Yeah, okay. It's a great question. I've been thinking about this a lot as I plan my own retirement strategy. I think there are three key things, at least that bother me, and I think I think everyone can probably empathize with that. One is I have no idea how long I'll live. Maybe I'll make it to 70, maybe I'll make it to 90. If medical technology improves, maybe we'll make it to 110. I don't know if you're an optimist. So that definitely makes it very hard to plan ahead. How much money should I be selling myself? The second thing that it's not clear what to do about is inflation and the cost of living. So we used to think that inflation was not a big issue. The Fed had conquered inflation and was going to be just 2% per year. And the experience of the last few years showed that this is not the case. And I think going forward, there's considerable uncertainty about whether inflation is truly tamed or whether it's going to come back. And just a small change between a 2% versus 3% average inflation can have a considerable impact on the level of the costs, especially once you think about 20, 30, 40, 50 years old.
Do you happen to have the numbers off the top of your head of the difference between 2% and 3% inflation over, say, 30 years?
I mean, it's basically, it could be just a difference by 50% of the level of prices.
Oh,
Just
wow.
between like 1% compounded for 30 years. I don't have it in front of me, but my intuition is it's in that order of magnitude.
Okay. Wow. Yeah, that's a lot.
So that makes a big difference whether something you think costs $1 million or $1.5 million.
Hmm.
And then I think the other thing is where do we think taxes are going to go?
Hmm.
We've seen the US having record fiscal deficits, and the debt is projected to keep increasing as a share of GDP. The question is whether that's sustainable, and at some point would expect to see either higher inflation, as this is part of the way that the debt is getting paid down. Should expect to see perhaps higher taxes and also higher interest rates as the market becomes less and less comfortable with higher and higher debt to GDP ratios. We've
It
already
sounds it
seen,
sounds almost like a trilemma there, right? So a trilemma being like you can have two of these things, but not all three. You can either maintain lower taxes and have interest rates where they are, in which case you're going to have inflation at a meaningful amount, or you could have
real,
high, hmm? You could
yeah,
have
real
higher,
interest rates.
yeah, real interest rates. You could have higher taxes and meaningful inflation, but then real interest rates change meaningfully, right? Which then affects the price of all assets. Or you could have, interest rates, real interest rates stay stable and inflation stays stable, but we have a massive amount of austerity and taxes and lower spending to pay off the debt. But you can't have all three benefits.
Yeah, no. The status quo remaining as is, it's definitely not on the table. Something has to change. The thing is, each one of these things in isolation going to impact the other two, right? So if you hike taxes, it's going to impact growth, which is going to feed back into how many taxes you're going to collect, inflation, interest rates. If I were to take a bet, I would think that the period of low or rather ultra low real interest rates is probably coming to a close. Maybe. I'm not sure, but I would definitely place a bet on inflation being higher going forward. And I don't think spending will be cut, so I think taxes are likely to rise. So all of these things are things one has to think about when planning the retirement portfolio. And it doesn't seem that there's a wealth of options that allows someone to insure against any of these changes. Right? I could buy annuities that's going to protect me against longevity risk, but it's not going to protect me against inflation. I could invest in tips. But again, how do I think about what's the right amount to invest in tips when I have uncertainty about how long I'm planning for? So I don't think they're great solutions. And to the extent that we think taxes are going to rise, I think it makes sense for investors to think about what's the maximum amount I can save tax-free. So figure out all different strategies about trying to manage the level of income and taxes you're expected to pay going forward.
So once again, we get back to there's three things, right? So there's three things that the macro economy has to worry about. There's three things for the individual, being the longevity, the inflation, and the taxes. And, as you say, longevity, you can get an annuity. Inflation, you can get tips. Taxes, you can pour money into a Roth IRA to the greatest extent possible. All these things, but each one doesn't necessarily deal with all three risks. There's you have to have multiple strategies on multiple fronts to deal with multiple potential challenges.
Yeah, that's exactly right.
Cool. So how do you envision ordinary people making sense of that? How do you envision somebody who's in the middle class or the upper middle class, who's worried about their retirement, who has enough money to save for retirement? How do they process this complexity?
I think it's very hard. I mean, I think there's also the fact that people don't save enough for retirement. Maybe they can't, or maybe they think that Social Security is somehow going to be enough. And I think once you run the numbers, you realize they're just simply not feasible. That at the current rates, Social Security is projected to run out of money basically 2030. So we would have to reduce benefits one way or another. So, the first issue is people are not saving enough. And then if you look at what they're saving, it's not clear that what they're saving in gives them protection against any of these things. People should be maximizing the contributions to tax-free plans, Roth, IRA, 401k, whatever. People don't even maximize their contributions to the 401k plans. So I think it can be a pretty costly mistake. And then, you want to think about investing in assets that give you some measure of protection against inflation, at least in the long. Nominal bonds don't, obviously. Tips do. And to some extent, stocks do, probably in the long run. Maybe not in the short run. So the thing is, there's not much they can do because I think there's a dearth of products that are easily available at relatively low cost that help people save in ways that overcome these three challenges.
Yeah, well, I mean, it sounds like there's just an education deficit as well, right? Like when I talk to the average person about if the subject ventures into finance, people aren't coming at it with the kind of complexity that you're and listen, you're a professor of finance. Of course, you got to know this stuff. But who else is going to make sense of that, right? Like,
I mean, it's very hard. I think what's going to end up happening is that people are going to be working for longer. The idea that you can retire at 60 with the same saving strategy as your parents, I think that goes out the window. And I think what's going to happen is as people get older and older, they're going to realize they don't have enough savings. So they'll have to postpone the year at which to retire. And maybe they move into part-time employment, maybe they find other careers, but again, that's something that you may want to start planning now.
Sure, yeah. I mean, I've always personally, I don't ever intend to retire. I like what I do.
Yeah.
And I enjoy my work.
Me too. My retirement plan is, on the job. But again, I think not everyone may feel like that.
Well, I was going to say, and the statistics say that we're very, very much in the minority, right? So, if you're looking at it, then again, we kind of get back to three choices, right? Either one,
Yep.
go find something that you love doing so that you don't ever want to retire and make money from that, which is hard, right? Two is work for longer at something that you don't want to do, which most people don't want to do. Or three is make the effort to really come educate yourself along the lines of what we're talking about and look at how you can weave together these multiple options to maximize your tax efficiency and protect against inflation risk and all of these other stuff, which is something that frankly, should be taught in every school, I think, financial literacy.
Absolutely.
And so people have to come and make the effort and, come to content like this and learn more. Otherwise, as you say, they're going to end up, it could cost you 2, 3, 4, 5 years of work by not thinking through these things.
I guess you can immigrate to a cheaper country, maybe. Uh, I don't know. I guess there are always options, or just downsize and really try to cut out your expenses. But yeah, deep down, I mean, there's no free lunch. Something has to give.
Okay. Well, so let's say you had somebody who came to you and said, "Hey, listen, I don't want to downsize. I want to retire when I was planning to retire, um, and I want to make the most out of the retirement savings. And I've got 20 years, right? Help me put together something that will survive what's coming in the next 20 years and set me up for a strong retirement." What advice would you give them?
I think they need to. I mean, I think they need to think about. So there are some things that they cannot easily do with off-the-shelf products, right? So the longevity risk, it's not easy to hedge alone unless you just buy an annuity. But that piece is not going to be protected against inflation. So you need to find something that will give you, in an ideal world, a guaranteed rate of return until you die. I mean, that's the ideal thing, right? So if you could choose any type of product, you pick something that gives you income until you die, and the rate of return on that investment is somehow indexed to inflation. Annuity products don't do that, right? They'll give you a 2% maybe bump, but of course, if inflation is 5% per year versus 2%, it may make a big difference. And they're not going to, for some reason, insurance companies don't know this. I don't fully understand it. I think, the product you guys have is useful because it lets investors invest in something that looks like an annuity, but at the same time generates returns that are closer to the returns of the stock market. The stock market, at least in the long run, has kept up with inflation. I think when inflation goes up, profits go up. That's going to translate into cash flows for shareholders. And then you want to have a big piece of your portfolio, I think, in stocks as opposed to bonds, because at least historically, stocks have considerably outperformed bonds. So some portfolio of Savvly stocks, bonds, in a way that as the retirement horizon gets shorter, and as the time to retirement gets shorter, you probably want to shift more money into bonds and stocks. Although, that depends a little bit on some assumptions. And then that's it. I think it's existing solutions are highly imperfect. Which
So
is surprising that, there's a whole financial industry that haven't necessarily solved this problem.
yeah, well, I mean, I think incentives definitely matter, and I think part of the issue is that most people haven't taken educating. Most people educate themselves far more about the purchase of a house or a car than they do how they're investing their retirement savings. And I think anytime you don't have awareness that you're going to just not have the pressure for better solutions because
That's true.
I think that's a component of it. Um, But like
I
as I
think it has to do with the fact that people like thinking about what car you buy gives you sort of immediate pleasure because you're gonna get the car right now, or think about retirement is kind of depressing. So nobody wants to think about retirement too much. But then, the car is such an inconsequential decision in terms of present value of your lifetime utility versus how you save your retirement. That,
so
it's kind of
I actually know someone who said that car purchase, not any single car purchase, but the sum total of car purchases and the way they're done over people's lives is one of the most consequential areas of their personal finance.
really,
Because what happens, and this guy, he was a financial coach. He was also at one point a car salesman. He said what happens is that people will buy a car and they'll drive it for 5 years and then they'll trade it in and they'll get a new car and then they'll drive it for 5 years.
let's
So
see.
they'll get a new car. And so, whereas like me, like I still have, a car that I bought 13 years ago, right? And it's still going strong.
Exactly.
Don't get me wrong, I got to
I
just
bought I bought two cars in my life. I drove each one for 15 to 20 years. So
right. And so if you drive for 15, 20 years, that's one thing. But if you're trading it in every 5 years, right? Because you want a new car, and then you're also financing, because he said that's other things. They'll do the car loans and the thing and that. And he says, and then if you look at what would happen if they invested all that money, it actually ends up being pretty meaningful for many people.
yeah, I just think that it's because nobody wants to think about retirement because it's a bit of a depressing topic.
Yeah.
But yourself, 30, 40 years down the line might feel very differently.
Sure. Yeah. Well, I mean, one thing, I've done a lot of work on what I call complexity levels of thinking and stages of development. Um, and if you look at it, approximately 85% of people in America do not really have much visceral time horizon past 1 year. Like in the next year, they're emotionally connected to what happens in the next year, but they're not emotionally connected to anything really past a year. And, I think that's part of the problem. That's part of the challenge. Whereas like if you look at most people in, say, venture capital or private equity, and you look at like what stage of development they're at, their time horizon is normally 3 to 7 years. And then when you turn and you look at the funds, that's the exact lifespan of the funds. Right? Like,
It's
so
pretty funny.
so so this very like root psychological research from like Ken Wilber's compiled a lot, hundreds of different papers. You see how it plays out in finance in some interesting ways.
That's interesting. Yeah. I wonder what drives it. I mean, I do think for retirement, partly it involves you thinking of yourself when you're older, and that's a bit of a depressing thought, so nobody wants to think that. I
Sure.
do this exercise with my students where when I try to teach the basics of discounting, basically, I ask them whether they saved the 15% recommended amount, and most of them say no, and I was like, well, where do you think that number comes from? Then I try to reverse engineer the assumptions that give that 15%. And something like 5% required rate of like a rate of return on savings, like 20-year work post-retirement, growth rates of this. And then I start putting some more realistic assumptions. And then quickly come up with numbers that are 20, 30, with 40% of their income needs to be saved in order to sort of maintain what they think retirement is going to be. If you're going to retire at 60 and there's a good chance you make it to 90, then saving 15% of your income is not going to cover it.
Yeah. I mean, I do think that, yeah, the amount that people save, and I mean, I'll be honest, I have saved less than I should have, at various points in my life for sure. Right? And I've
Because you like your job. Same with me. I like my job.
well, yeah, that's one factor. Is like as I said, I'm not planning to retire, so that gives me a little bit of leeway on that. Um, and also I mean, I just know that's just not the case for most people, right? And so then the question is, yes, there's the input of how much you save, but there's also the question of how you save it. Here's a question for you, because this is something that I've noticed in the past couple of years, is there have been a lot of people who have basically convinced themselves that all they need to do is pour their savings into real estate, and then they will make so much money and they will just be able to retire like within the next couple of years.
I mean, depends where. In Chicago, I think real estate prices are probably still lower than they were pre-2007 once you adjust for inflation. So I think the answer is where. Say yes, if bought real estate in the Bay Area, then sure, it has done well in the last 10, 15 years. Is it going to be the same going forward? I have no idea. I think this real estate as savings, I mean, that's how people I grew up in Greece, so people definitely think like that. But part of the reason is because these were periods of relatively high inflation. And if you had the money in the bank account, you basically got completely squeezed, and there were no other ways of saving, right? There's not a functioning stock market. There's not really a liquid stock market that people can invest in. So I think people think of real estate as the main savings vehicle, relatively underdeveloped economies, I think. But somehow this thinking passes through. So I guess if you're an immigrant like me, people think the same way. But from my perspective, I think probably, investing in Victor. So, we ended up building a house, and that's probably by far the worst financial decision I ever made.
You and me are confessing our financial sins on this webinar.
Yeah, no, that by far. I mean, that was clearly I lost money. And I mean, I enjoyed my house because I liked the house, it was great, and it's how I wanted, but as a financial investment, I think it was a complete disaster. And I think the other thing that people don't factor in is that there's a significant amount of upkeep in real estate. So you can't just look at selling prices. You also have to figure out how much money people actually pay to maintain, refurbish, and especially in a world where property taxes keep rising. I'm not at all convinced that the return to real estate is all that high, or that safe for that matter.
Yeah, I think what happened is that when COVID happened, you had this drive to working from home, which, put pressure on real estate prices. You had a lot of money flowing into the economy through both fiscal and monetary channels. Fed was buying up mortgage-backed securities. Yeah. There was a lot of SBA loans just dealing out massive amounts of money to anybody who had a business that had any revenue to it. And so you had all this money come in, and real estate prices shot up. And I think a lot of people saw that and then have extrapolated that forward and think that's what it's going to be in the future. And I think that that's probably going to bite a lot of people in the butt.
And then you get 2008. That's how we got into 2008, where people were like, oh, yeah, real estate prices can only rise. That's what's happening to China right now. Property prices are 30% down. So...
Well, but so the Chinese prices being 30% down, though, the problem is that's not the real number, right? It's actually worse than that.
Because it's worse than that. I mean, just the reported price numbers. Yeah.
Yeah, because I remember that there was a point where developers, I read they were trying to give a 50% discount, and the Chinese Communist Party, the government, come in and said, no, you can't do that. You're not allowed to do that. They don't have a free market economy. So
No, I know. But I think it's just, a lot of people lose money on houses. I mean, maybe people don't internalize because of inflation. It's like, yeah, I bought it for $1 million. 20 years later, I can sell it for $1 million. Or 1.2, so I made money, but then you don't think about all the amount of money you spend on maintenance every year. I spend a ton of money on maintenance. It's depressing. It's like everything breaks all the time.
But if we look at your original three concerns, right? You talk about taxes, you talk about inflation, you talk about longevity. Real estate can serve to some extent as a means of keeping up with inflation, right?
Yes, it does to some extent. But yes, I mean, inflation is a big component of the CPI, so mechanically it does.
You mean housing is a big component of the CPI?
Yeah, housing is a big component of this. Yeah. I don't think it helps with taxes, especially if you live in a state like Illinois that has let's just say it's fiscally precarious, because the first thing that is going to get taxed is housing. You can raise income taxes, you can raise business capital income taxes, but people can leave. But you can raise property taxes, and there's nothing you can do to avoid it. Because if property taxes double, the value of the house is going to go down. There's nothing I can do. It's going to be baked in the house. So there's nothing you can do to avoid it. So I think we may solve the inflation issue. Doesn't really solve the longevity issue unless you think, you can do some type of reverse mortgage. But it definitely doesn't solve the tax problem. In fact, you're having this big tax liability.
Right.
It's
So,
part
so
of the reason
actually,
why I never wanted to buy real estate in Greece, because now it's like you have this sort of you have this unfunded liability. Like I feel like I owe the state of Illinois rent on my house. And at any point in time, they can just hike up the rent.
sure, sure.
What am
So,
I going to do?
yeah, so as you say, right, it can help. It can help with inflation. It could help with the longevity because the reverse mortgage is basically an annuitized income stream, but now
Yeah.
it exposes you to the property taxes, right? And then like you can go to the tips, which really help protect you from inflation, but they're going to be lower growth than a lot of the other options, and you need a certain amount of growth to juice the
Yeah.
component. So there's a lot of different options. And how would you recommend people think about blending these into a portfolio that's really going to protect them?
Again, I don't think, there's no magic bullet. So each one solves a little bit part of the problem. I think I'm not sure that real estate has any advantages over tips for hedging inflation beyond the fact that you get to live in a house that you own, so that may have other indirect benefits. But as an investment vehicle, I'm personally not at all sure that real estate is all that advantageous. Like put differently, if I could rent the same house that I live in, I'd rather rent it than own it.
Well, in the context of investment real estate, what people are normally doing is not so much that they're buying their own houses, if they're buying other properties and renting them out to other people, or hoping that they can flip them in a year or two to make more money.
I think that's a very risky strategy.
I'm sorry, say
I
again?
mean, that's a very risky strategy. I mean,
Okay.
think of all the mid-sized banks that are in trouble because they own all this commercial real estate. What happened to all the banks that were on like malls, right? 20 years ago, 30 years ago, malls may have been a profitable investment. I mean, now they're probably all in default. So what happens to the portfolio of these loans is so yeah, I don't know. I'm not sure where this idea that real estate is somehow a good risk return strategy comes from. I don't think it's true if you look at the data carefully. I think the problem is we don't have very good data, because what people often do is they just look at purchase prices. This like the Case-Shiller index, for example, count that looks at transaction prices. But then I think it misses all the cash flows that happen in between due to improving the house. Right? Just because I bought the house for $1 million, I sold it for $2 million, doesn't mean that I made 100% of it if I ended up spending $500,000 or $1 million renovating. So I'm not at all sure that at least the data tell us that real estate is a particularly amazing investment. I mean, people of course buy their house, but I think that's because it's nicer to live in your own house than to rent from somewhere else. Although effectively I am renting from real estate, or if it's good counting.
Okay. So in summary, we want to address, as an individual investor, right? There are three main things that we want to address.
Yeah.
The inflation can be addressed with either trying to keep up through stocks or maybe real estate, and having some protection with inflation protected bonds. And the closer you get to retirement, the more you shift into the inflation protected bonds and away from from trying to keep up, because there's sequence of returns risk and everything.
And you might want to put more money in stocks, at least relative to what a target fund would say, simply because stocks are better hedged for inflation than normal bonds.
Okay, so over allocate to stocks compared to a target date fund.
I would probably do that.
Okay, and then for longevity, as you say, there's maybe a reverse mortgage, there's maybe an annuity, there's the Savvly product, there's Tontines, there's the whole longevity hedge thing. I think most people don't really know much about that area. And that's a whole nother discussion. And
Yeah.
then there's taxes. And so one thing is, you noted, I remember you said that you expect tax rates to go up. If you expect tax rates to go up, wouldn't it make sense to try to get as much into a Roth IRA or a Roth 401k as compared to a standard IRA or standard
Yes.
401k?
Yes. I mean, there's an offsetting effect, which is you might think that your expenses are lower in retirement, so you might be in a lower tax bracket. But that's offset by the fact that chances are that rates are going to go up uniformly. So I would think on the margin, you probably want to put more money in there. Try to maximize how much money you put in your Roth IRA right now.
Okay. And ultimately, you would recommend that investors combine all of these strategies to make sure that, they at least have some
Yeah,
degree of buffer and some degree of protection against all of the three things that you mentioned.
exactly. I mean, the optimal mix is probably hard to pin down, but I think if you do a little bit of it, it's better than not doing it.
Cool. Well, any closing words, any closing thoughts for our audience?
That's it. It's a hard problem. Um, and it's not pleasant to think about. But unless you're okay working for a very long time, at some point you have to sit down and burn. And I think I have to say it's very scary being retired without an income stream that you used to. Like I can see my mother, she's retired, she's been for a long time. And the I think just the stress, the financial stress that it puts her having a income stream that's essentially fixed and there's nothing she can do about it. I think that's just it's almost like too much. And of course, I mean, I help her where I can, but at the same time, she has her own sense of pride. So she's like, no, I have to. I don't accept help from other people. This is mine. It's my problem to deal with. But yeah, no, it's not pleasant having to live in a world where prices can fluctuate, whereas your budget stays fixed.
Well, thank you, Professor
Thanks.
Papanikolaou, Dimitris,
Thanks, Sean.
coming on. Thank you for being real with everybody. Thank you for opening our eyes. I certainly did not think about the cash flow component of real estate as an expense and the property taxes and this and that when I was valuing it, right? So even I learned something. So again, really appreciate your time. And for everybody, once again, this webinar was sponsored by Savvly, your personal pension designed to provide lifelong financial security and peace of mind. Have a wonderful day.